All right. Good morning. Good morning. I've got something exciting to talk to you about today. We're going to talk about Tesla. All right. And I listened to Elon Musk last night, and Elon was saying, if you guys put $150,000 into Tesla, it'll make you a millionaire. I thought, I want to be a millionaire. Who wants to be a millionaire? All right. So let's talk a little bit about Tesla. Okay. We're going to see who's playing this big game. So the Tesla game is something that's quite been unique, and we've been following it and watching it. Been a little bit disappointed with them because where the rest of the market took off and went straight to the moon, right? Let's see if I can get that out of the way. Here we go. So everything else went straight to the moon. Tesla didn't. Now, Tesla had a little bit of a rally in here, but then it's just been going through this narrow, sideways little triangle pattern, just like this, right? Just like a train on rails, right through a little pattern, just like that. Okay. So all the other stocks have taken off and went to the moon and up breaking all-time new highs and everything. And Tesla hasn't done it. I think it had a lot to do with a number of things. One of which is that Elon got a little bit political, and that was a little bit disappointing to a lot of people. And so he's had some struggles, but I think has he kind of gotten out of it now? Not really. I mean, it's Elon. He's going to always be saying what he thinks and what he wants and talking about things, but he is out of the White House at least. And, he's not feuding with Dr. Trump, with President Trump. So I don't know. But the thing I want to talk about is the accumulation distribution model that we talk about when we're looking at the large institutions. All right. So there are a list of things that I think people need to know to trade. So a lot of times people just say, Lan, I just want to know the most important things. Just what do I need to know to trade? Just so I can know where to start, to where to study, and what to do. And so there's a list of things, and I'm just going to list them here. The first thing you need to know is you need to know Wyckoff. All right. It's the accumulation distribution model. Wyckoff, I'm not going to spell it all out. Accumulation distribution. All right. Let's try and at least try to capitalize it. So we're going to come in here. The first thing you want to learn is the Wyckoff accumulation distribution. Why do you need to know that? Well, because the biggest players in the whole world, right, that control the world, and we talked a little bit about this yesterday with a little bit of our gossip. We were gossiping about who was invited to go with President Trump on his trip overseas and who wasn't. And that was kind of very telling. And just as a little side note, I got to give you this little side story. I was busting my gut last night. I was laughing so hard. My wife was looking at me like, why is that funny? To me, it's funny. All right. But Tim Cook, yeah, and you all know how I feel about Apple. I think Apple is a worthless company. All right. And Tim Cook was at the White House, and Trump brings him in with him. They come walking in together, and Trump gets up to the podium and he goes, well, I just want you to know, and before this, you realize you got to know the little backstory. Let me give you the backstory before I tell you what just knocked me on my butt laughing. Is that the backstory is that Trump's been trying to get everybody to move back to bring all their manufacturing back to the U.S., right? I mean, that we all know that. Trump's been working really hard to try and bring more companies back to the U.S., and Apple refused. They said, no, we're a Chinese company, and that's where we're going to stay, and we're going to maybe move a little bit offshore of China to some other offshore companies, but we're not coming back to America. They made a couple of little, maybe we'll do this or maybe we'll do that, and they kind of made a couple perfunctory little things to kind of, Tim Cook is not a big Trump fan. All right. And so this so he's been resisting coming to America with his bringing Apple back home, because Apple, there's a video, and I keep telling you, I've got the URL to it, and I just need to remember to send it out to you. It's of a guy that's gone through and just told you completely Apple is actually wholly owned by the Chinese, Communist Party, basically. So you have to understand the backstory. And so then Tim Cook was not invited to go to Saudi Arabia with Trump. Wasn't invited. This is a little bit more, I think we're getting probably back into a little bit more story on our on our gossip tour here. So that's kind of the backstory. Apple has resisted everything that Trump's been wanting to do. They don't want to come back to America. All right. So Trump comes trotting into the White House last night, and he's got old Tim Cook, president of Apple, in tow. And they come in together, and it's just so hilarious. Trump gets up to the microphone and he goes, I have decided that we're going to put a 100% tariff on anybody on all chips outside not manufactured in the United States. If you are manufacturing chips outside the United States and you try to bring them into the United States, it's a 100% tariff. And he goes, and not only that, I am going to let you know that if you tell us that you're going to bring your chips back and then you don't, he says, now this is the thing. This is what's really cool about this. If you tell us that you're going to bring your chips back, well, we're not going to charge you a 100% tariff. You don't have to pay that 100% tariff because you're coming back, right? So there's this lag time. I understand, you're not making them here in the US, but if you promise us you're going to bring them back, well, we'll drop that 100% tariff to zero. But if you tell us that you're going to bring them back and then you don't, like Apple's done, they've done nothing. They just gave us these perfunctory little trading ideas that, we're going to come back, but then they never do. Trump's like, we're going to nail you with 100% tariff. And if you don't come back, even though you said you were, we're going to go back in time and we're going to charge you that 100% tariff from the beginning of time all the way forward. Not only are we going to start charging 100% tariff from that point forward, we're going to go back in time and grab you. It's, by the way, I've got Tim Cook from Apple here with me. Tim, you want to come and say a few words? Tim Cook walks up to Apple is the greatest company in the world, and we're so happy to be working with President Trump. We're going to bring $600 billion worth of investments back to the United States. And I was just laughing so hard. It was the funniest thing in the world. I'm like, here's Tim Cook, who's lied to us, for the last number of years, saying, we're going to come back to the United States. And you never do, because they're wholly owned corporation by the Chinese company. Trump's like, 100% tariff. And if you do lie to us and tell us you're going to bring it back, and then we're going to nail you from past history too. And finally, and he trots out good old Tim Cook onto the thing. We're going to bring $600 billion of investments back to the United States, like a little child, like a little kindergarten kid toting around with his daddy. I was like, who's your daddy, buddy? Who's your daddy? I was laughing so hard, mostly because I don't like Apple. I think they're a worthless company. And second of all, because Tim Cook's lied to us so many times and he doesn't like Trump. And Trump didn't invite him to Saudi Arabia, so he felt left out. All right. No, the big boys have all gone without me. That's no fun. And then he brings him in and says, if you don't bring your chips back, you're going to have to pay 100%. And you're going to have to pay past because you lied to us about saying you're going to come back and then you didn't. And then little Tim Cook gets up there. It was so funny. I was laughing so hard. It was so funny. Anyway, that's only because I don't like Apple. Yes, I have my little Apple iPads and my little Apple iPhones, and I like their products and stuff. I just don't like them as a company. I think they're a worthless bunch of bums. All right. That's neither here nor there. All right. Who cares? Let's talk about what we need to do to make money. First thing you need to know is you need to know the Wyckoff accumulation distribution model. Second, you need to understand Elliott wave. All right. If you don't understand these two concepts, you can't be traders. I mean, that's simply put. I'm just going to say it right out. If you don't understand these two concepts, you can't be traders. All right. Or investors. I don't think you can. You might be able to find some success with a little 401k or something by putting it in there and leaving it for 30 years because the market just naturally goes up over time. But if you're going to actually try and become wealthy in the financial markets, these two concepts, you got to understand it. And I'm not selling you something. I'm just telling you, you got to go study Wyckoff accumulation distribution. You got to understand Elliott wave. If you don't understand those, and you don't have to learn it from me, just go search it on YouTube and watch Wyckoff accumulation distribution videos from other people. Go watch Elliott wave. Go buy the books from Amazon. Don't give me any money. I'm not trying to sell you something here. I'm trying to help you understand how I've made millions of dollars. All right. It's through the Wyckoff accumulation distribution and Elliott wave strategies. The third thing you need to understand is you need to understand Fibonacci. And what is Fibonacci? Fibonacci is not hard. Fibonacci is just a ruler. All it is a way to measure your tools. All right. Just measure, count, measure, set up, trigger, follow through. I've got a book. Yes, I do have a book, and I've written this stuff all down, and you can go buy my book. Just go out to Amazon's lanturner.com. Actually, you got to put the H in there, my middle initial, or it won't come up. Lan H. Turner, and you can get my book, and I put this stuff in there. It's more of a summary than anything. I mean, it's not an in-depth book on Wyckoff, and it's not an in-depth book on Elliott wave, and it's not an in-depth book on Fibonacci. But what it does is it assumes that you know what Wyckoff is, because I give you a summary of what Wyckoff is. I give you a summary of Elliott wave. I give you a summary of Fibonacci. And then I assume that you're going to do extra study on your own. You're going to go out and learn what those things are, and then I'm going to show you how to put them all together. And the most important thing is not to know Fibonacci or not to know Elliott wave. It's how do you put all this stuff together to build a plan that will help you understand what's going on. All right. So Wyckoff, Elliott wave, and Fibonacci. Now, Fibonacci, the most important component of that is just understanding the delta cone of probability. And delta cone of probability comes from understanding options. All right. Because if you understand the delta in options, which is where you're going to go study. Now you're like, what does delta in options have to do with Fibonacci ruler? Well, that's why the Fibonacci works. You have to understand what you're measuring. So you count, measure, and set up, trigger, follow through. So what is it that you're measuring? Well, if you don't know what you're measuring, well, I know Fibonacci. I watched a video from this guy on YouTube, and he taught me all about Fibonacci. So I'm a Fibonacci king now. If you don't know what you're measuring and why, then knowing Fibonacci is not going to help you a whole lot. I mean, you might accidentally do something right. But really, Fibonacci, you have to understand it from the delta cone of probability, what it is. All right. And we talk about it in this class all the time. Those of you who are regulars, you know what the delta cone of probability is. But that's what Fibonacci is. All right. So you got to know those three components. Now, there's some other components to it that you've got to understand as well, which are just as important, but they're not the fundamental structure. Those are your three horsemen right there. The three horsemen of the apocalypse: Wyckoff, Elliott wave, and Fibonacci. You got to have those under every trade that you do needs to have those. If you're not using those in your trading, there's nothing I can do to help you. That's it. That's your most important stuff. Go out and study the living devil out of those things. All right. Make sure you understand them. The next thing you got to understand is you got to understand setups. All right. You got to understand what a setup is. So you got to know what a setup is. So that's where these reoccurring price patterns come in. That's where triangles come in. That's where head and shoulders formations come in. That's where pennants formations, flags, right? That's where all of these setups and breakouts come in, because Wyckoff accumulation, Elliott wave, and Fibonacci are basically going to set you up with the fundamentals. All right. They're going to help you identify where the market's moving through the nature of a fundamental move. Now, the fundamentals drive the long-term trends. We all understand that. All right. So when you look at earnings and you look at, all the kinds of stuff that are going to give the intrinsic value to the stock, that's the important thing that you need to understand. And that's what Wyckoff, Elliott wave, and Fibonacci are all structured around. It's all about measuring, counting and measuring the waves and the patterns and where the big investors are putting their money. Okay. the Wyckoff accumulation distribution in particular is all about big institutional trading. And that's what this chalk and money flow is for. The chalk and money flow is a tool that I use to help me identify Wyckoff accumulation distribution. It's just kind of a guide. All right. And so that is what we're trying to accomplish when we use Wyckoff, Elliott wave, and Fibonacci. We're trying to calculate, measure, identify where the large speculators are putting their money and when they're buying in and buying and getting out. All right, hold on one second. Losing my voice. Okay, so the fourth thing is the setup. So that's your recurring price patterns. That's your trigger for entry. Once you find these wonderful locations based on Wyckoff, Elliott wave, and Fibonacci, what do you do with them? Well, you got to know when the triggers are, when the setups are, when you're going to get into the market. So that's your setups. All right. So you got to learn the setups. So you can have great fundamentals, but you can still get smoked if you don't know how to get into the market and when. All right. So that's the setup. And Wyckoff, Elliott wave, Fibonacci, I'll help you with that. And then you got your setups. So the setups, and then the next thing we got to do is the trigger. All right. So setup, and then 5 is your trigger. What's going to trigger you to get into the market? Well, you find the setup. Like right now, we're looking at Tesla, and we're getting this setup. All right. So the setup is this nice little wedge pattern that's coming in here, and the trigger is the breaking of that trend line in anticipation of the rally that's going to come out of there. All right. So that would be a trigger. What's going to trigger you? Well, the breaking of a trend line, breaking of a mathematical model like the blue light system or the parabolic SAR, the ATR, where there's lots of little mathematical models that'll help you set up your triggers, right? But triggers come along all the time that aren't triggers that you want to take. But if you understand Wyckoff, Elliott wave, Fibonacci, and the setups, and then the triggers will make sense to you, and you can use the trigger that lines up with your other analysis. And then, of course, the last thing is your follow through. All right. And what's follow through? Well, that's your risk and money management strategies. Risk, we call it risk and money management. So that's just learning how to use orders. Am I going to use a stop order, a market order, a limit order? How am I going to get into the market? Am I going to trail for exit? How am I going to get out of the market? Buy low, sell high. And people always forget about that other component. Sell high. People don't do that. Simply put, they'll buy low. A lot of times people do very well. Retail traders are pretty good. They learn this stuff pretty well, and they buy low. But what they never do is they don't ever sell high. Okay. They always think the market's going to go higher. So they'll buy right here. They're really smart. They'll come in here and they'll buy that, and they'll see it and they'll buy it, and they'll get in and they'll be, oh my God, I'm making more money than God, and I'm so happy. And they'll even, sometimes they'll even be smart enough to get in and add some more right here. Not usually. Usually they get out right here. This is where the weak hands get out. All right. Shake out the weak hands. They're all done. That's about it. That's about all a retail trader gets. If they get out, because they get scared. Either that or they stay in forever. All right. They either get out too quick and they miss this. And then because they got out here and they, got back in right back up here, they hang on forever. And then they ride it all the way back down here. And then this is where they get out. So retail traders have a really hard time getting out at proper locations. And that Fibonacci will help you with that. All right. Fibonacci and Elliott wave. That's what Fibonacci and Elliott wave are. They're good for helping you know when to get out of a market. Okay. Now, just because the Fibonacci tells you that you're at the top of the trend and that it's time to get out, doesn't mean a market can't go higher. It certainly can. All right. It can always take off and do one more. And then you can be mad. You can say, well, Lan was stupid. He doesn't know what he's doing. He's not teaching me the proper way. I should have just stayed in the market forever, like I always do. But then the market does flush. And then you're like, oh, well, it wasn't Lan still doesn't know what he's doing. All right. Nothing's perfect. Okay. You're never going to get the absolute perfect top and the absolute perfect bottom. I think even Claire talked about that the other day with one of her little podcasts. All right. So the whole idea is just having experience and trying to understand these concepts. But this will keep you on the straight and narrow. All right. So when you're going to come in and you're going to trade and you're going to go off and you're going to do lots of study on your own, which you should be doing. You shouldn't just say, oh, I'm going to learn everything from Lan because Lan knows everything. Because it's going to take you a long time to just study with me. You got to have lots of other things that you can go and listen to other people's opinions, but they're going to help you learn the things that I'm trying to teach you. So I'm trying to teach you Wyckoff accumulation distribution. Go out and let other people help you learn Wyckoff accumulation distribution. All right. Elliott wave. Lan's going to teach you Elliott wave. I'm going to teach you how I use Elliott wave and the most important components of Elliott wave, but I can't teach it all to you in like one day. So run out and have somebody else help you teach you Elliott wave. And then same with Fibonacci. I'm going to do my best to teach you Fibonacci. You can come here and learn from me, and I'm going to teach you how I use Fibonacci, how I put these things all together. But in the meantime, go out and listen to other people teach you Fibonacci because, Fibonacci's Fibonacci. Elliott wave's Elliott wave. There's lots of people who know how to use those things. I mean, know how to teach them. They don't necessarily know how to put them all together and make one big trading strategy out of them. But, that's the name of the game. You get lots of people's opinions. I'm just one guy. All right. But here's the thing that I want to talk to you about, and I want to show you in the Tesla model. Okay. So we're going to pull up, I got a little chart for you, and I want to pull up for you. Let's see. It's right here. Okay. And you guys have all seen this before if you've been in my class. This is the Wyckoff accumulation distribution model. Okay. What we call this distribution cycle, Wyckoff accumulation and distribution cycle. So markets have a tendency to start off in the accumulation stage down here at the bottom. This is where big firms, BlackRock, Vanguard, State Street, these are where these big firms come in. And what they do is they accumulate their shares, and they do it quietly because they don't want the market to take off and run without them while they're trying to build big positions. So while the market is soft and weak, they try and come in and buy up the shares. And then they take it off, they pop it, they try to get it to go, and they run the market. And the reason they run the market is because there's two sides to every trade. For every buyer, there's got to be a seller. And if you have a whole bunch of shares that you just bought, well, the way you make money is you sell them, right? You have to sell them higher. Well, retail traders, we like to buy low, and we like to also try to sell high, but we don't sell high. We just hang on to them forever. So what happens is they want to sell out of all their positions that they accumulated down here. So the accumulation stage is down here in the bottom right. This is where they start their accumulation stage. And as the market rallies and starts to go up and all the retail traders start to buy in. Now, remember, there's two sides to every trade. There's a buyer and a seller. In the financial markets on the bigger scale, everybody who is buying up the scale is got to be buying from somebody who's selling. Because if, the big uprun, everybody's buying. No, everybody's not buying. It looks like everybody's buying, but not everybody's buying because there's got to be a seller for every buyer. Well, if that market is taking off and going to the moon, and everybody, as far as you know, because you watch NBC, MSNBC, and they're telling you everybody's buying, well, who's selling up that entire uptrend? Who's selling to all the people who are buying? This is accumulation model. It's like, well, I know the answer, Lan, because you just told us. It's the big institutions who just bought everything down here. That's exactly right. So while they buy low, and then we as retail traders come in and we start to buy in here, buy. And we like to buy high. So they sell to us all the way up that uptrend. And by the time we get up here, they're out. They have no more shares. And who has all the shares? You do. Me. I do. You do. We do. Retail traders. Okay. So if you look at it from the larger standpoint, there's two traders in the world. There's only two. And Wyckoff talks about this. He wants you to think about the market as if there's only two traders. There's the retail trader and there's the institution trader. And they buy and sell from each other. And guess who loses all the money all the time? It's the retail trader, loses his money all the time. 80% of retail traders lose money. Only 20% make money. All right. So the big institutions, they have all the money in the world. You've heard me say this before. They have the trillions and trillions of dollars. The only money they don't have is the retail trader money. They don't have your money, the money that's jingling in your pocket and burning a hole in your pocket to go and buy some stock that's going to make you rich, rich, rich beyond your wildest dreams. So they want to take your money. And this is how they do it. All right. There's a buyer and there's a seller. The, the buyers in a big uptrend are always the retail traders. The sellers are always the institutions. At the top, when we get to the top, the retail traders, they start to sell out. And who buys in? The institutions. All right. So that's how this works. So you're always think about yourself. Anytime you think, I want to get into this market, I want to buy. Well, who's going to sell to you? And are those people making more money than you? Why would you buy? Now, if you understand the concept of what's going on, you can say, I think that the institutions are running this market so that they can sell out their positions. Well, I'm going to make money in this uptrend. Okay, do that then. Make money in the uptrend because you didn't buy down here and buy a whole bunch and sell out all the way up the uptrend, which is a little bit difficult sometimes for retail traders to do because our pockets aren't very deep. So what we do is we end up waiting for a time or an opportunity to wait for a setup or a trigger and look for this rally because we want to rally and we want to go with it. We want to make money on that big rally. That's how we make money, and that's okay. Nothing wrong with that as long as you understand what's happening. Okay. And that's the point that I'm trying to make. As long as you understand what's happening and you have that inside knowledge of both the retail trader and the institutional trader, you can usually do pretty good at this. Now, it's not always perfect. Nothing's ever perfect. All right. And even though you have this insight knowledge and you understand all of these little processes here, it's still difficult to make money. All right. Still difficult. Market trading is hard. Okay, that's why most people just throw all their money into a 301k or a 301k. What the hell's a 301k, Lan? A 401k or into an IRA, and they just leave it there for 30 years because trading's hard and they don't want to do that hard part. They just want to let it grow over a long period of time and hope that the U.S. economy grows, and it has. And so, the GDP, gross domestic product of the United States, continues to grow at usually a 1 to 2 to 3, depending on who's operating the controls at any given time. We can get it up to 3-4%, sometimes 5%, just like out of control big. That's fantastic. So, but the market over a long 30-year period of time has a tendency to grow 3-4%, and that's what that market is, and that's what you're doing, and that's what you're investing in, and that's okay. There's nothing wrong with that. I'm not saying that that's a bad thing, but if you want to buy low, sell high, buy low, sell high, buy low, sell high, and try and capture bigger moves in there and take advantage of the different wave patterns of the market, you got to be a little bit more active. All right. Got to be a little bit more active. So that is the nature of the beast. And so this is the Wyckoff accumulation distribution model that I want to show you that's going on here in Tesla, along with the Elliott wave patterns and the setups and triggers. And the whole point that I'm trying to get to is I'm thinking with my analysis, I believe based on what's going on that right now is a good time to buy some Tesla. All right. So we're going to look and see if now isn't a good time to buy some Tesla in anticipation that we're going to get one of these Wyckoff setups. So I want to show you in the past performance is not necessarily indicative of future results, but it's the best we've got. All right. It's the best we've got. So let's come in here and I want to show you something. I'm going to show you where I took the Wyckoff picture and I laid it right over the top of this chart with Tesla. Can you guys see that? I hope you can see that. See if I can make it a little bigger. Is that bigger or is it just making there we go. There's a little bigger. All right. So that is the chart that you just saw me showing you over there in the track and trade software. And then I took that Wyckoff accumulation distribution model and I laid it over the top of the Tesla chart. And look what it does. This is a classic sign of what's going on in this market. So we got the accumulation stage down here. All right. So this is where the accumulation is beginning. This is where all the big institutions were buying down here. The retail traders weren't buying here because they were scared. Oh, the market's going down. Oh, there's all kinds of bad news. All right. And you remember we talked about the news cycle that drives these markets. And just remember, they're tools of the big institutions. All right. So the big institutions use the news to grab you by the nose and lead you around and tell you what you're supposed to be doing so that they can make money. You got to think about them like that because that's where they get their news. Now, I will give them a little credit and say I don't think that they're leading you the wrong direction down the road on purpose. Yeah, I'm going to stick with that. That they're not doing it on purpose. Did we just so we don't get demonetized? All right. Not that I care about the monetization of my, but at least we won't get the video taken down. All right. So they're going to lead you around and they're going to grab you by the nose. And they're going to say, you should buy here. You should sell here. You should buy here. You should sell here. Where do they get their information from? All the news sources come from BlackRock. They come from Vanguard. They come from State Street because they have these are giant institutions. I mean, they have trillions of dollars. They make Elon Musk, who's the richest man in the world, right, look like pocket change. Okay. Literal pocket change. That's how big they are. All right. You want to know who the global institutions are that run this world? BlackRock, Vanguard, and State Street. All right. And there's a few more, and I'll show them here to you just a minute. But these guys are the ones who run the world because they have all the money. Who runs the world? The people with the money. Okay. So here's an example. I'll show you. Jim Cramer works for MSNBC. Now he used to be a trader. Used to run money. He still has a little fund that he runs, but mostly he's an institutional man now. Okay, and there's actually a fund that tracks him and all the things that he says and tells people what to do. Because there's a lot of people who listen to him, and if he says to buy something, man, they buy it. Doesn't matter how much money they've made over the last 10 years working with him or not. If he says buy, they buy. And he's got a very loyal crowd. All right. A lot of people love him. I have nothing against him other than the fact there is a fund that tracks exactly the opposite of everything he does. If he says buy, they sell. If he says sell, they buy. They do exactly the opposite. They track him, and every trade recommendation he gives, they do the opposite, and they are killing it, making all kinds of money. All right. So Jim Cramer is kind of an institutional man. He gets his marching orders from the big institutions now because that's what he's at. Now I've got video of him. And I think I published some of it in Pit News Magazine at one point, teaching classes to other fund managers to show you how to manipulate the market and manipulate the people by setting up lies and sending out false news releases to get the market to do things that they wanted to do to make money. I literally got him on camera. No, it's not AI. These are old videos of him teaching classes on how to manipulate the market through the media. Now he's in the media, and obviously he's part of that crowd, and it's not like he doesn't know it exists because he does because he taught it. All right. He taught it. So I don't know what to think of that guy. I really don't know what to think of that guy. I think, there are really super smart people. Some of the smartest people in the world who believe the stupidest shit. All right. They've told themselves, it's called cognitive dissonance, right? So they've told themselves something for so long. They've told themselves the lie for so long, they actually believe it, in spite of their brilliance in every other respect. All right. And I wonder if that's not a little bit of what's happening with Jim Cramer. He knows in his bones that those guys are manipulating these markets through the media. And now he is the media, and he is helping them do what he was against before. Now, I don't know if he's really even against it. Maybe he was on the team doing it. But he's certainly not on the team anymore. Well, other than the fact that he's got his own little fund, right? So I don't know. It's not for me to decide. I'm just telling you the story. Don't shoot the messenger. I'm just, decide whether you love that man or not. And I don't have anything against him. I think he's a nice guy, and I like him. I like to watch him. I got his newsletter, comes to me all the time. We talk about it all the time, right? I used to pull it up all the time and say, hey, let's go see what Jim Cramer's saying. We'd read down through Jim Cramer's newsletter and we'd go look at it. And, the problem with that is that 95% of the time I wouldn't see any reason to buy the thing that he was recommending. you got to realize too that here's another thing. You got to realize that Doc Brown has done a tremendous amount of. He wrote a paper on this. Him and a guy out of I think the university was MIT maybe, or I can't remember. Anyway, the two of those doctors, PhD guys in finance, they get together and they like to publish in these financial journals. And so that's how they get their tenure, and that's how they do all this stuff in the university. So they were writing an article. They were doing a tremendous amount of research. And what they wanted to find out is if these newsletter people who send out all these newsletters and make trade recommendations, if any of them ever made any money. And so what they did is they went and they accumulated like the top 20 or the top, I don't know how many it was, but it was a whole bunch of newsletters from the very top, very best, most popular, most common newsletter trade recommendation advisory services in the whole United States. They went and got them all. And they went back and for this peer-reviewed paper from these PhDs, they went out and they back tested all of the trade recommendations of all these newsletters. Not one made money. They were all losers. Every single one of them didn't make money. And he'll tell you, he'll say, we wrote papers on this, and none of these people made money, and don't listen to them. They don't know what they're talking about. And so, there's empirical evidence proving that these guys don't make money. And the reason, in my opinion, it's not because they don't know how to trade. I think most of them do, but it's because they're putting out a product. And it's like, oh, well, let's see. I got to write my newsletter today because I got people paying me $199 or $400 a month to get my newsletter to make a trade recommendation. I guess I better make a trade recommendation. So let's see, what should we put into our newsletter this month? No, that's the wrong way to be an advisor. That's reverse. You don't come in and say, well, let me figure out something to recommend. You look at the world and you say, well, is there something I should be recommending? Right? I mean, there's a difference there. Oh, there's an opportunity right here that sets up with my structure and strategy that has a high probability of, that's what I should be telling them, right? I should write up a story about, Tesla coming through this process and going into what looks like to me as a place to be buying into the market. As opposed to saying, well, I got a newsletter and I got to give them, 10 recommendations or 8 recommendations this month. So I guess I better go find 8 markets that I can recommend in my newsletter. Well, that forces you to make a recommendation on a market that might not be set up to trade. So don't trade it. Don't recommend it. Don't recommend it if you're not going to put your own money on it. If you're not willing to go and be don't start a trade advisory service to tell people to buy things if you're not going to buy them yourself. You should only recommend people buy something if you're going to buy it. So I'm going to tell you, I just put $125,000 more into Tesla this morning. I bought this. I am not telling you to do this. I'm not telling you to buy Tesla. And I've told you that a million times. I'm not here to tell you what to do. I'm telling you what I do. I'm just here to tell you what I do. And I don't charge you for it because I'm wrong a lot. I bought some of Moderna and then that was a bad mistake. I turned around and took it right back off. Right? I wanted to try it. I thought, well, maybe it's on a run. Maybe it's starting to make a move. And then suddenly they came out and John F. Kennedy, or not John F. Kennedy, JFK, JRFK, whichever Kennedy from the Trump administration came in and took away all of their contracts a couple of days ago. I'm like, well, that's not good news. Take that baby off the table. So, you try and you're not always successful. But I'm going to try with Tesla. And I'm not here to tell you that you should be buying into Tesla. Not at all. I'm just telling you, this morning put another $125,000 into Tesla because I believe that this Wyckoff accumulation distribution model is going to continue. And here is the next reasoning of why this is going to occur. Okay, so I'm going to get rid of this image. And you can see that we got this thing coming into a nice little triangle formation, a little wedge pattern here. And those of you who, again, come and play in my sandbox with me, you've seen these slides, right? And so we're going to slide down here. Come on, pick up with me. And I'm going to show you the slides where we're talking about these reoccurring price patterns. All right, so this is the reoccurring price pattern section of my slide deck that comes, and it's a supplement to the book. So if you go get the book and then you get this, it's kind of a continuation, because at some point I got to publish the book, right? I mean, I can't be working on the book for the rest of my life, which is kind of what I do. I kind of continually write forever, which is also why I have a magazine. Pit News Magazine is just a continuation of everything else. I write all this stuff down, and at some point I got to give it to you. Well, that one's done. I've written that one. Now I got to go and move on to this one. This is a supplement. So this is what this is. Oh, I got an article I got to write. So I write that one, and then how am I going to get that to them? Oh, I got an idea. I'll start a magazine, and then I can continue articles and writing things up about all this stuff that I'm teaching. I don't know why I do it. Don't ask me. It's something in my blood. I don't know. I just want to. I want to help people. I want to show people. I want to teach people. I get excited about it. You know, how many of you guys have a hobby that you just love so much you just want to go talk to people about it all the time? You know, I fly airplanes, I ride motorcycles, and I just love to go talk to people about riding motorcycles. Do not, whatever you do, follow me on Facebook. I have a Facebook. Don't go over there and join my Facebook. This is for my family and stuff, and it's for my friends, and people come and follow me all the time. All that you're going to see, you're not going to see anything about the financial markets. You're not going to learn anything about. I get a little political, and I offend people, and and then mostly I'm talking about motorcycles and airplanes. Don't go follow me on Facebook. I'm not here to try and get a big following, make a whole bunch of money. I'm just here to show you what I'm doing, what I do, and I like to teach people for some reason. But I don't do it on Facebook, and I don't do it on Twitter, and I don't do it on any of these other places. So don't go. Just if you want an education at the university, I go teach at the university, and here on YouTube. It's the only place I teach stuff. So don't go try and follow me on all this social media stuff. That you're just going to learn to hate me over there, because all I do is post motorcycle pictures. All right, but the point is that I'm very excited about some of this stuff. All right, I love talking about motorcycles. I love riding my motorcycle. I talked about my motorcycle, and Claire went and made a podcast about me talking about my motorcycle. I got to be careful what I talk about, because that girl listens to everything I say, and then she goes and writes it up and makes stuff about it. So if you haven't listened to Claire's podcast about the motorcycle, you got to go listen to her most recent podcast, because I went off on my motorcycle the other day, and so she went and did a podcast about it. So anyway, these are the reoccurring price patterns, and I want to show you the reoccurring price pattern that's in my little reoccurring price pattern supplement here. And you're going to find it right in here as I come down. I'm showing you all my reoccurring price patterns, all the ways to trade them. We're going to get into triangles and wedges here in a second. Right there. Look at this. Now, this is kind of a consolidated version. But if you look at these chart patterns, these reoccurring price patterns, let's see if I get any more down here. I think these are the ones I'm looking for right here. See these little symmetrical triangles and wedges? And then this is kind of the big, this is what Tesla's going through right now. All right, this is the up version right here, as we have the flag going up, and then this is the down version, is the bearish side of it. All right, so it goes into this little consolidation. And look at this pattern right here. Now, I know it's a little squishy here on the paper, but look at that in comparison to what's going on. Let me see if I can shrink this down. Just like that, just like that. Look at that. It's almost like it's coming out of the book. It's almost like somebody, Tesla, Elon, read my book and created this pattern right out of my book. Not that I invented the pattern. I didn't. I just copied it from somebody else who taught it from me at the Chicago Board of Trade when I was there. All right. That's the pattern right there. Look at that thing. Now, if that doesn't look like a rally pattern, a bullish pennant, now this is a pennant. This is more of a triangle wedge, but it's the same thing. It's just elongated. All right. So here's your patterns. If that doesn't look like that little symmetrical triangle right there, you're never going to see one again. If that's not one. If that's not one, I don't know what one is. So does it mean it has to break out the top and go up? No, it doesn't. They can break out the bottom and come back down too. See, there's an example of their symmetrical triangle. Rally up, go through the triangle, and flush out the bottom. They do that. See that? But this is what I think it's going to do. I think it's going to go long. I think it's going to break out the top. I don't think it's going to break out the bottom. It could, and if it does, I'll probably dump some of my Tesla, because I've already got a whole bunch of Tesla, and I'm just adding on to another very large position. Now I'm doing it through, again, I'm not here telling you what to do. I'm just telling you what I'm doing. All right. I did it through, I bought mine. I bought $50,000 of TSLY, not TSLA. I bought TSLY. And that's the yield max fund, which is going to take profits along the way. If this market takes off and goes, I'm going to get to participate a little bit in the upside, but there's going to be a cap on it, which is going to, because we're selling covered calls. So if this thing actually does explode, I would make more money being in TSLA than I would in TSLY. But TSLY takes profits along the way. And I like that. It's very similar to what the large speculators do, right? They buy a whole bunch down here, and then as the market rallies, they take profits along the way. Could they have made more if they didn't take profits along the way? Sure, they could have. They could have ridden it all the way to the top, but people are buying, and that's how they make money, is by selling along the way. So they couldn't really hold all the way to the top anyway. That's only something that retail traders do. So large institutions, they sell along the way. They take profits as markets rise. Well, that's what YieldMax will do for you. YieldMax, if you put it into their TSLY, the market's going to take profits along the way through covered calls. And that's how it does it. Now, it also doesn't make as much money as if you just threw a whole bunch of money in there and grew it all the way to the top. Yes, you can make more money if you do it that way, if the market runs and goes a million miles an hour. Is it going to break and run and go a million miles an hour faster than what the YieldMax can make profits? I don't know. You can go, and there's a little calculator that we can go look at, and it'll give you an idea of how fast the market has to run to beat the outperform the YieldMax fund, because we know it'll do it, and it's just a mathematical model. Where's our calculator? Come over here, and if you go into the break-even calculator, right? This is the Pitt News break-even calculator, because Pitt News magazine, that's my company. And so I try to create all these tools for us that we can use. No, there's no charge for this tool. Of course not. And then you come in here and you just go use it. It's over there at pittnews.com/dividend-calculator. And then you can go into the little second one, break even, and you come in here, and we're going to come, and we've got to find, warning calculator. Oh, I got an error. Undefined array key. Well, that sucks. I'm going to have to go work on it. That's why it's free. No guarantees that things going to work. All right, so we're going to put Tesla in there, and Tesla popped up. All right, so now we can look at down here. We can see how far the market's going to go how far it would have to go before the Tesla TSLY wouldn't make any money. All right, so you're going to make more money in TSLA than you would in TSLY. Now, this is saying that it's going to go pretty fast. Okay, you're going to have the market go like a rocket ship to get and go and make as much money as the TSLY fund right there, 50%. So about 50%. You can see the number right here. Tesla reinvested is, if you just do cash, it's going to go a little bit. That's just a cash out, 15. Well, right now, it looks like it would have to go about twice as fast as the a 50% increase rate of return over and above the Tesla fund before it breaks even. So in this case, you can see at a 50% increase, that's where you're going to break even, about $15,000 and $15,000. And even the cash value out is about $15,000. So you're going to gain about 5,000. So that'd be a 52% return, 55% return before you get to basically what that's showing you is break even. All right, where the two will perform equally. And then as you see, as you slide it up, and it doesn't go high enough to make that go above it, but the red line is Tesla. So you buy the Tesla, and you'll notice that if the Tesla just goes flat, well, because you're selling covered calls, you make more money than the flat market that goes nowhere and makes no money, right? That makes sense, right? If you're selling premium and you're collecting premium from an option that has premium, you're going to make more money if the market just goes flat. So for all of us who have got a little bit of money in Tesla, in some of these unique funds like TSLY, we've been making more money. We've been making money every month because they're selling the premium. And even though the market, Tesla's been going sideways for the last 2 months, and not made any money, well, we've still been collecting because we've been selling premium, right? So once Tesla starts to go up, which is this red line, right? Once Tesla starts going up, well, we still get our money from the dividends, but because the market goes up, notice we get to go up too. So we get to collect and take a little bit of that premium as well. But the Tesla, see how it's going up? It's going to finally catch up to the yield max fund and start making money about the same as yield max fund. And once it goes above that, well, then it'll make money faster than the yield max fund. The yield max fund will go underneath and the red line will go above. But you can see right now, it's got to be going 50% just to catch up to the Tesla fund. That's why it's a pretty good tool, pretty good fund to be in, because it's going to give you the dividends along the way, and you get to participate in a little bit of the upside, but not as much as if you had the stock itself. And once the market explodes, well, then it's going to outperform the Tesla, the fund. But there's always ways that you can make more money. You're going to pick your strategy and you're going to stick with it, and you're going to make money that way because it works for you. And for me, I understand it because it's options, and it's what I would be doing with if I was trading my money myself. And I think that these guys can trade it a little bit better than I can, so I let them trade my money for me, and I've been doing more of that lately. All right, so that's why I put money in Tesla. Now TSLYY, I don't have a little calculator for them, but you can see they've been going down. But what they've been doing is they pay a high return. So if we go back over to the little calculator and we go over here and we go into the investment calculator and we come in here and we put $10,000 in. Now I put 50,000, so let's put 50,000. $50,000, and you'll see that on the list, TSYY is at the very top. Now that's right now because the market's been going sideways, and these are traded with puts. So rather than selling covered calls, they're doing cash secured puts. And actually, they're not cash secured. They actually secure them with another put option. So they're just doing a put spread. That's all it is. Very simple put spread. And they're collecting premium on Tesla using put spreads. And because the market's just been going sideways and not been taken off, well, they've been doing quite well. The yield is 140%. All right. So that means monthly with my $50,000 in TSYY, if it continues, if the stock will continue to rise, I'm not going to participate in this market, TSYY. If I put my money in there, I will not participate in a penny of rise. I won't get any, none, no money at all. All right. Because when you sell a put, you don't get any of the increase in value, but they're selling premium, and so they're collecting premium, and they're actually selling premium not on the TSLA itself. The underlying that they're selling, and I should probably make that change here and here because they're not selling it on TSLA. They're selling it on a 2x leveraged ETF, and I can't remember the symbol. I got it in Track and Trade. Let's see if I can find it. I don't want to waste too much time. Tesla funds, Tesla, I think it's right here. So these are some of the 2x TSDD, TS Granite shares, 2x Opportunity Trust. I think it's something like this that they're, and I'm not exactly sure which one of these it is. TSL, that's TSLY, TSPA, TS, I think it's this one here. It's a 2x. See that? It's 2x. So it's it's funny because a lot of people are like, oh, be really careful. It's double the amount. You can make twice as much money, yes, but you can also lose twice as much money. It's a 2x market. And I'm just like, people from the futures market are laughing. They're like, you're getting 2x. We get 60x over in the futures market, and you guys are freaking out because you're worried about the 2x. We get 60x at the futures market. So I'm just laughing. I'm like, these people who are all freaking out. Oh, be real careful because this thing's got leverage on it. 2x leverage. I'm just like, wanting to slap my head. Can't because I got a hat. Slap my forehead and go, yeah, in the 60 futures market, we got like 60, 80, 90% leverage. So these guys are freaking out. Oh, look out. It's got 2% leverage. Okay. All right. Well, be mindful of that. You should be mindful of that. I'm giving you a warning. This is a 2x market. All right. So if you put it in here, you can lose twice as much money in your investment as you would if you put it into Tesla. You can also make twice as much money, which is why TSLAA, which is the new Granite shares thing that we're playing with, they sell options on this TSLT, and I think it's the T. I think this is the one they do it on. they sell their options on this fund instead of on TSLA. That's how they get these big returns, right? Because they're double the return. So if we come back to our Lan's UBI portfolio and we go back to Tesla, all right, so that's what we're looking at, and that's the name of the game. And so that's what I did. I went in and I got about $125,000 additional money. Now, if we pull up my UBI portfolio, I have not updated this yet because I did it just before class. And I told you I'm doing a little rebalancing, so I've killed a couple of markets in here. So I took money out of, this is my real money account right here. This is my, let's see if I can get it full screen. All right, so let's come in here and make it so we can see it a little better. It's at 100%. Let's zoom it down to 75. Maybe that'll, harder for you guys to see, but easier to see more stuff. All right, so I killed, what did I kill? I took off the table Snowy. That one I took completely out. So that's not in my portfolio anymore. I took Snowy out. Didn't I? Snowy, current value. MRNY, I got that one. Where's it? I took one out and then I took some profits. I took some profits actually off of PLTY. So I had a whole bunch of money. I was making all kinds of money in PLTY, and PLTY, we had to go look and see because it took, I didn't take it all out. I just took some of the profits off and it went into cash. And so now I put it into Tesla, because if we go and we look at PLTY, see, it's taken off going to the moon. That's PLTY. Let's go to PLTR. There we go. See that? I took some profits right there. I didn't take it all off, but I'm taking profits. As the market rises, sell high, right? Somebody said once, buy low, sell high. Well, it's high. Doesn't mean it can't go higher. Certainly can, but I took some off. All right. We're in the top of the third drive. We're peeking out up in here. Drive 1, counter trend, drive 2, counter trend, drive 3. Doesn't mean it can't go to fourth drive. And this is a market that's on fire. I mean, this thing is absolutely on fire. But I just took some profits off. I took about, I think 20. That's where the 25,000 came from. So I took 25,000 out of there, and I put it over into TSYY. Okay. So that's what I did there. That's where I got some of that money. So I'm just rebalancing. I'm moving money around, taking it off the winners, giving it to the ones that I think are going to go. And most of the problem is most everything's gone. Everything's took off and gone to the moon, and just absolutely breaking all-time new highs. We're making money hand over fist, and that's when we come in here, and we got to be careful, because that's when we start getting so exuberant we think we can't lose. And remember when that happened, that exact same thing happened back here, right? We got so exuberant we thought we couldn't lose. We were making all kinds of money. Our portfolios were enormous, and we were buying, right? And then suddenly, fluff, even this market, Palantir, died. You go look at the S&P 500, right? S&P took a big nosedive right there. And so that's got to the top of the third drive pattern, and it flushed. And so you guys were all here with me when we went through that. And I took all my positions off except for my yield max funds. I kept my yield max funds, and my yield max funds had to ride through that whole thing down, and it was painful. I called my son several times on the phone going, what are we doing? Why are we doing this? Why didn't we get out with these yield max funds? Well, they're paying for themselves. They're not losing anything. They're just not making anything. And it was so frustrating. And we all rode through that thing. But I was glad I took all of my other positions out. I got out of them, right? And this thing rode down. We didn't lose any money, but it took us, all this time to come back. We finally, 2-3 months later, we're back. And now the market's going to the moon, right? And so I don't want to be caught in that again. I don't want to have a flush out and be stuck in it. So we're in a 3-drive pattern, and I'm taking some profits off. And I'm going to go and put them on Tesla. And the reason I'm putting them on Tesla is because Tesla didn't participate in that big rally. And I think the reason it didn't participate is because Elon got political. Because Tesla's got good earnings. I mean, they make money. Well, they didn't do too well in this last earnings. But Elon got on there and he was telling people, hey, we're an amazing company. I don't know why people aren't buying our stock. And I'm like, I can tell you why people aren't buying your stock, Elon. People aren't buying your stock because you're political. Stop it. Just get back to work. Put your nose to the grind wheel. Let's go to the moon. No, let's go to Mars. So I think that now we're going to see, I think we're going to see a break in this market, and I think we're going to see it go. Doesn't mean it won't. And I didn't put any money in TSLA. I didn't. I put it all in all of these other funds that will make me money, even if Tesla doesn't take off and go to the moon. But Elon said, put 150,000 in there. It's going to make you a millionaire. Okay. I wrote on it when he said that. Don't follow me on Twitter. Please don't follow me on Twitter. But on my little Twitter account, I was like, I've got over 150,000 in there now, Elon. When am I going to be a millionaire? So I'm joking around, of course. I don't know. Nobody knows when the market's going to go to the moon. But I think that's a pretty good setup. So I'm just telling you what I did. I'm not telling you guys what to do. But here is another thing I want you to be aware of. All right. So this is something I want you to be aware of. Who's buying Tesla? So let's talk about the major institutions who are buying Tesla right now. Now remember, because we're talking about the accumulation distribution model, right? We're talking about the Wyckoff accumulation distribution, which means the large institutions are going to be buying. So are they? Are they buying? Let's go see. All right. I thought this would go give me my little flippity dippity do. Where's my flippy flipper? Oh, there it is. Okay. Here's the passive institution buying. So Vanguard, look at this. Vanguard added 3.6 million shares in Q4 2024. Well, when's Q4 2024? 2024 Q4. 2024, December 24, they bought a bunch of shares, right? Well, that's back in this region here, right? So that's when they bought. So they bought going into this. They were part of that. So that was Vanguard. And they total holdings of 242 million shares, 7.5% of Tesla. So Vanguard owns 7.5% of Tesla, primarily through passive index funds of total stock ETFs. Now they have to buy because they have some funds that are, and that's what they mean by passive institutional buying, because they own funds that what's the word you want to call it? They mirror the S&P 500. So you can buy a Vanguard, I think it's VAG or something, VVGG or VGG or something like that. Anyway, they have a Vanguard fund that is almost identical to the S&P 500. And so you can buy that. And that means that because they do that, they have an agreement, they have to buy the same things that the S&P buys. All right. So they have to buy so they can make those be the same. They have to buy the same things. And since Tesla is in the S&P 500, all these big funds that have these mirrored versions of the S&P 500 have to buy the same funds that the S&P 500 buys. And so that's why they're buying passively. But Vanguard has been buying, and they buy every month. They have to. It's the name of the game. And then BlackRock added 7.4 million shares in Q4, and then they added another. Now BlackRock added another 3.5 million shares in Q1 of 2025. Now when was that? That was just recently, right? Because we're going into the end of the second quarter of 2025. Now I don't know if this is updated enough to know if they've been buying in the second quarter or not, but I just pulled these stats off of Google. So I don't know how far back this goes. Maybe we don't know if they've been buying in second quarter, but this is the first quarter. Added in the first quarter of 2025, they added another 3.5 million. BlackRock owns 6.3% of Tesla, and Vanguard owns 7.5% of Tesla. So the two of them together own almost 15% of Tesla. Combined, they own about as much as Elon does. All right, State Street holds about 3.1% of Tesla, likely increasing holdings modestly through the index-based funds. And then here's some smaller ones, Geode Capital and Capital World Investors. Geode Capital owns 1.85, Capital World Investors owns 1.34. Each added a few million shares, predominantly passive. Again, they've got these funds that they're just passively buying all the time, all right, to to match the S&P. So now we come in here, and this is ARK Invest. Now, this is the one that is an active strategy. All right, these guys are actively buying. And ARK Invest is Kathy Woods. And so for those of you who know Kathy Woods and are kind of follow her, she's like this superstar in the industry. She's really made some waves, and people really respect her. And she has what they call the ARK investment funds, and she's got ARKK, ARKQ, and ARKW. And we'll go look at those here in a second. But she's purchased 143,190 shares in July 24th of 2025. That's not very long ago. It's like 3 or 4 weeks ago. She bought 44 million shares, or $44 million, 143,000 shares. $44 million worth of this stuff to put into her little funds here, RKK. I don't want to call them little because they're not little. Bullish bet on Tesla AI self-driving tech. She really believes that Elon's self-driving stuff that he's got going, this robo-taxi thing that he's got going. And you know what? Elon's not even excited about the robo-taxi stuff. He's like, oh yeah, that's going to happen. We're just going to make that happen. That's already happening. He's not excited about it. You know what he's excited about? He's excited about his little robots. Elon thinks these robots, he thinks he's going to sell $1 trillion worth of robots. And he's getting ready to sell them. He's almost ready. He says, we got a version that's ready to go. We can sell it to the public. And I don't think they're going to be selling them to the public primarily. I think probably will. I mean, you can go out and buy one if you want. They're like 30 grand, I think is what he said they're selling for. But he's going to probably be selling them to businesses, people with factories that have, that do this kind of thing. Oh, we got to, do this thing, or we got to pick this up and put it here. Robots can do that. Right now we got humans doing it. And so they're going to go and buy these robots that can do this manual, boring labor. And he thinks that he can sell more than he can make, more than he can manufacture. He's going to sell them faster than he can make them. And so that's what he's excited about. And that's why he thinks more so even than the cars. He thinks that he's going to sell these robots. And if you put $150,000 in Tesla right now, he says you're going to be a millionaire off of it. All right. So we come in here and we go, Bridgewater Associates acquires 153,000 shares during Tesla's Q1 dip. All right. So 153,000 shares. That's Bridgewater. That's a lot of shares. That's more than Kathy Woods up here on the ARK. She bought 143. These guys bought 153 on the Q1 dip. So strategic timing of entry at lower prices. All right. So here's Goldman Sachs. Now, Goldman Sachs is a timing buyer. Their timing indications purchase likely made during periods of price weakness, smaller sizes, but deliberate strategic accumulation. So we got big guys like Goldman Sachs. And these, and when we're talking about these companies, Goldman Sachs is one of the smaller ones. And you all know Goldman Sachs is huge. They're a big organization, right? Big company. We all know they're a big company. They're one of the small ones. All right. BlackRock, Vanguard, State Street, those guys dwarf Goldman Sachs, and they're all buying this stuff. All right. So Goldman's coming in here and bought 1 million shares. He bought 1 million shares in the first quarter in that dip. So here we go. Passive buyers, large index-based purchasers, Vanguard, BlackRock, and State Street, reflects the broad market trends rather than targeted strategies. But then we have the active buyers like ARK Invest, Bridgewater, Goldman Sachs, strategic deliberate accumulation during price dips, and they align with the Wyckoff definition of smart money. All right. So when Wyckoff says the smart money is buying, that's what these guys are doing. The smart money is buying. Key takeaways. Passive institutions add stability but reflect general market trends. Active strategic buyers signal specific bullish conviction. And strategic purchases during low price periods align with Wyckoff's smart money accumulation theory, because that's what they do. They buy low and then they sell out as the market runs up. So we're going to run back and we're going to look at ARKK, ARQ, and ARKW just for fun, just so you can see some Kathy Wood funds. All right. So we're going to come in here. Let's create a new one so we don't muddle this one up. We're just going to call it Kathy Woods. ARKK funds. And we're going to say okay, and we're going to come in here and we're going to add in just these three: ARKK, ARKQ, and ARKW. All right, so there's our 3 funds from Kathy Woods, and she's got more than this. You can go over and do some research on Google and it'll show you all of her funds, but these are the 3 that look at this thing. Look at this thing. Unbelievable. Look at that. Next generation ARK generation internet. Next generation internet fund. Look at that thing. Holy smokes. She's killing it. Look at this one, just bought a whole bunch of Tesla. All right. ARQ. Look at that thing. Holy smokes. Holy cow. You want somebody else to trade your money for you? Just give it to Kathy. Holy cow. Here's RAKK. Look at that thing. That's just unbelievable how she's been doing. Just absolutely killing it. And that's why she's famous. That's why she's popular. That's why she's, she had the #1 fund a couple of years ago where she just broke all the records, just killed everybody, just knocked everybody out of the park. So you can see, man, she just really has been ripping it. Look at that. All of her funds just been killing it. So anyway, that's kind of the way these markets, these big fund managers are buying up Tesla. So if you want to play the game, I don't know. Again, I'm not telling you what to do. I'm just telling you what I like to do. All right, guys, that's pretty much all I got for you today. If you have questions, let me know. And I'm rebalancing my portfolio, and I'm working on my spreadsheet here. I messed it all up because I rebalanced everything. So a lot of these are wrong now. And I think I'm going to try and move everything into my new business model. I like this model better. This is the 3rd iteration. This is as far as I've got. I've only got 3 in there. And now I've gone and screwed them up. So let's see, this is MSTR. So I took $5,000 out of there and put it over into Tesla. I took $26,000 out of here, NVIDIA, and put it into Tesla. And I put $68,000 out of here, which is Palantir, and put it into Tesla. So you can see I took profits. That's where I got the money from. I took it from my profits out of these other funds. It went into cash, and now I put it back into Tesla. Is it going to be a good move? I don't know. These have been good markets for me, but they're all at the top of the 3rd drive pattern. So that's why I'm taking money out, taking some profits. I may have to ride back down through some of these, but everything's going so well. They're talking about lowering interest rates. I mean, we may not get that big blow off on that 3rd drive. We get that. It's already made the 3rd drive. It's broke the 3rd drive. It's just how far back is it going to go? Before we do that, let's go take a look real quick at the S&P, should we? So if we come back in here to the S&P, I'll just put her in here with Kathy Woods. See, you can see it already broke. That's our 3rd drive, and it made the. Is that all we're going to get? Is that all we're going to get for a 3rd drive break? I don't know. It's still below the blue lights. But that's our 3rd drive pattern. So again, this is the Elliott wave. But this little thing right here was just so tiny. It almost, on any normal market, that would be like a normal 2nd drive. Well, 2nd drives are usually bigger than the 1st drive, and this one's not. So my concern is that the well, I don't know. The mathematics say we got to blow off the top, right? I mean, if we go and lay the Wyckoff theory over the top of this thing, where's it at? Look at that. I mean, we just laid this over the top of Tesla, right? It's not going to let me shrink it. Come on, Apple. Not Apple, Microsoft. Come on, Windows. All right, so this is what we're looking at right here. It comes down. We went through the accumulation stage right here. And then we went up through the rally, which is this little section right there, right? Is this little thing right here, I think. And then we went up through here, and this is where we're at. We're right here. And look what's coming. I mean, if that follows through, just like Tesla did, if that follows through, this is why I took profits off up here. I'm like, I'm taking my money and running because I think we're going to get this dip. Now, I don't think it's going to come down. I don't think it'll come down into this 3rd drive down here. I don't think we'll go all the way to the bottom. Market's too strong. There's too many positive things going on. I think we got to get a blow off though, and it might just come here. Maybe we'll get it down here. That's what I want because then we can put more money back in, right? Now, I'm putting money into Tesla, but if it'll come back down to that, and that's why you use your Fibonacci ruler, right, from the top to the bottom, and the delta cone of probability tells us down here, I don't think it'll come down that far. I mean, this is where I don't know, nobody knows, but this is where, come on, give me the right tool, Mr. Lan. Grab the right tool. Can't you get the right tool? Where's that little square? There it is. All right. So right in here is my target zone. That's where I think we're going to see, and it doesn't have to. And the reason I say that is because if you come back here, man, it did this 4 drives. It went 4 drives last time. It had that blow off right here, and then it went drive 1, drive 2, drive 3, drive 4. And then it kind of did this whole little tossy thing up here at the top, just like we see in the picture, right? This little thing up in here was that little thing right there. So this big long drive had 4 drives in it, which is very unusual. Usually we only get 3. If you go back and look in time, there's another one right there you can see on the screen. 1, 2, 3 before it flushed back down. 1, 2, 3, 4, and then it flushed back down. And then it kind of did this little toppy thing. And that's when we got this big move here, all the way down. All right. So the institutions, the big institutions are the ones that are driving this stuff. And that's why when I look at this, I'm like, I don't want to be heavy into this market way up there. It looks like this to me. And I don't know what it's going to do. All I can do is look back in the history and look back in the past and say, this is a model that we know works. And it's worked so many times in the past. And it worked so many times on individual stocks. But I can show you times where it didn't work, where the market actually broke these rules to some degree. So what's it going to do? What are you going to do? I took profits off. I got out. I took a whole bunch of money out here. Over $250,000 I took out right there. I still got some in, but they're in some funds that I'm not really worried about, right? If they flush down a little bit, I can ride down through them and anticipate the rally and going into the next accumulation stage, and I'm not going to worry about it because they're longer term positions. But I've taken $250,000 out of the market right here because I don't think it's going to go up. It doesn't mean it can't, and I could, but I took it out and put it down into something else that I think is going to go up. So I'm not completely in cash. I've still got about, I don't know, 100 and a couple. I've still probably got $250,000 sitting in cash. So anyway, that's what I'm doing. I'm not telling you guys what to do, just telling you what I'm doing. And if you like what I'm doing, maybe you can learn from it. And that's why I'm here, just to maybe help you guys learn a little bit. If you guys have any questions, please let me know. You can write them up in the comments out on the web, or you can send me an email. And let's come over and play with a few of these little things. These are fun to play with before we send you off. Make sure you hit the thumbs up. Give me the little like thing if you like this class. Hitting the little thumbs up thing is always fun. I like to see the little thumbs up things.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's my software, and then of course we got to do the Pitt News Magazine stuff.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right, there you go. We will see you guys Tuesday morning, bright and early, 8 o'clock a.m., and we're going to review this, and we're going to see where our Tesla's at on that day and see how we've done over the last 3 or 4 days, all right, over the weekend. Have a good weekend. We'll see you guys on Tuesday morning, bright and early, 8 o'clock a.m., Mountain Standard Time, right here, same place, same bat channel, same bat cave.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, Definitely subscribe to Pitt News Magazine. You'll thank us later.